What if I told you that a 3% yield today could actually outperform a 12% ETF by the time we hit 2027? There is a hidden mechanism in dividend growth investing that high-yield chasers completely ignore until it's too late. We're comparing the top-performing income funds of 2026 to see which one is actually winning the passive income war. My name is Luis, and I spend way too much time thinking about dividend investing, passive income strategies, and why the financial industry keeps selling people products that look amazing on the surface, but quietly destroy wealth underneath. If you're someone who's tired of watching your paycheck disappear before the month is over, and you're trying to build real passive income that actually pays your bills one day, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. We're about to have a really uncomfortable conversation. And by the end of this video, you're going to look at those shiny double-digit yield ETFs completely differently. I promise you that. Look, I'm going to challenge something most YouTube finance channels won't tell you. The high yield equals more passive income idea, it's one of the most expensive misconceptions in personal finance today. And the data backs me up on this. Hartford Funds did a long-running study going back to 1973, and they found that dividend growers and initiators delivered an average annual return of around 10.2%, while the highest yielding stocks, the top 20% by yield, returned just about 6.8%. Same time period, same market, massive difference. So let me ask you something. If high yield was actually winning, wouldn't that gap be the other way around? Yeah, it would. All right, so let's actually break this down, because I think a lot of people don't really understand what they're choosing between. Dividend growth investing is basically when you buy companies that pay a smaller dividend today, maybe 2 to 3%, but they consistently raise that dividend every single year. Think about Microsoft, Johnson & Johnson, Procter & Gamble, and Costco. These aren't sexy. Your barber is not bragging about them at the shop. But they've been raising their dividends for 10, 20, sometimes 60+ years in a row. High-yield ETFs, on the other hand, are funds that package together investments designed to spit out massive monthly or quarterly distributions. We're talking JEPI, JEPQ, QYLD, the YieldMax single stock ETFs advertising 40, 60, sometimes 80% yields. They use option strategies, covered calls, return of capital, and all kinds of financial engineering to manufacture that income number on the marketing page. Now, you might be thinking, Lewis, just give me the answer. Which one wins? And I will. But you need to understand the math first, because otherwise, you're not going to believe me when I tell you. Here's where it gets really interesting. Let's do a real example. Imagine two investors. Both are 35 years old. Both invest $50,000 today. Both reinvest every penny of dividends. We're going to run this for 25 years, until they're 60. Investor A, let's call her Jackie, buys a basket of dividend growth stocks yielding 2.5% today. But that dividend grows at 8% per year, which is actually below the historical average for dividend aristocrats. The stocks themselves appreciate at about 7% annually. Investor B, let's call him Liam, buys a high-yield ETF paying 10% today. Sounds amazing, right? But here's the catch nobody talks about. These funds typically have flat or even declining share prices over time because they're paying out more than the underlying assets are growing. So let's be generous and say the share price stays flat and the distribution stays at 10%. After 25 years, here's what happens. Jackie's portfolio is worth approximately $385,000. Her annual dividend income? About $19,200 a year. And, this is the kicker, her yield on her original $50,000 cost basis is now over 38%. Liam, with his fancy 10% yielder, his portfolio is worth about $541,000 if he reinvested everything. His annual income at that point? Around $54,000 a year. Wait, hold on, Luis. Is Liam winning? Yeah, of course, on paper, in this oversimplified version, he is. But here's what most people don't realize. I made some really generous assumptions for Liam. I assumed his share price stayed flat. In reality, look at QYLD. Launched in 2013 at around $25 a share. Today, it's trading around 17. That's a 32% decline in the principal. Look at most YieldMax funds. They've lost 40, 50, even 70% of their share price in some cases, while paying those flashy distributions. So let's redo the math with reality. If Liam's share price declines just 3% per year, which is conservative based on actual data, his portfolio after 25 years is worth approximately $235,000. And because his share count is being eroded by NAV decay, his actual income is closer to $23,000 a year. $385,000 portfolio, $19,200 income, and growing every single year by 8%. Liam, $235,000 portfolio, $23,000 income, and her income is going to catch up and blow past his within the next 5 years. This is where it gets really interesting. Because Jackie's income is growing. Liam's income is shrinking in real terms once you factor in inflation. By year 30, Jackie is making nearly $30,000 a year in dividends, and Liam is barely making $20,000 with a portfolio that's been cut in half. Now, let me address the elephant in the room. You might be thinking, but Luis, I need income now. I can't wait 25 years. I hear you, and that's a totally valid concern. But here's the thing. This is where psychology comes in, and this is the part nobody wants to talk about. There's a behavioral finance concept called present bias. It's the same reason people choose $20 today over $50 next month. Our brains are wired to overweight immediate rewards. And the high-yield ETF industry has built an entire marketing machine around exploiting this exact bias. A Vanguard behavioral research paper looked at investor behavior in income-focused funds versus total return funds. And what they found was kind of brutal. Investors in high-yield products underperformed the actual fund returns by about 2.4% annually because they kept piling in at the top and panic selling when distributions got cut. With dividend growth investors, that behavior gap was only about 0.8%. Why? Because dividend growth investors aren't constantly checking the yield. They're not refreshing their app 15 times a day. They're playing a different psychological game. Look, I get it. There's something deeply satisfying about seeing $850 hit your account every month from an ETF. I'm not going to pretend that doesn't feel good. It feels amazing. Feeling good and being good are two completely different things in investing. Here's an analogy that I think really nails it. High-yield ETFs are like one of those payday advance apps. They give you money right now. It feels like free money. But quietly, in the background, they're taking a piece of your future paycheck every time. Dividend growth investing is like getting a 3% raise every year for life. It doesn't feel like much in year 1. By year 10, you're making double. By year 20, you can't even believe how much you're earning. Which one would you rather have? Now, I do want to be fair here. There are some legitimate use cases for high-yield ETFs. If you're 70 years old, retired, and you need income today, and you don't have a 25-year time horizon, yeah, something like a SCHD or a JEPI might make sense as part of a diversified portfolio. I'm not saying these products are evil. I'm saying they're being marketed to 30-year-olds on TikTok like they're a get-rich-quick scheme. And that's where the real damage gets done. Here's what most people don't realize about 2026 specifically. We're in a really weird environment. Interest rates are still elevated. The S&P 500 dividend yield is hovering around 1.3%, which is near historic lows. So a lot of investors are reaching for yield in places they shouldn't. There was a Morningstar report that came out recently showing that flows into derivative income ETFs hit over $90 billion in the past 2 years. $90 billion. That's a herd. And historically, when the herd piles into one strategy, it's rarely the right time to join them. All right, so what do you actually do? Let me give you some concrete steps you can take today. Step 1. Go look at your portfolio right now. If more than 20% of your holdings have yields above 8%, you need to seriously ask yourself why. Are they preferred shares, REITs in a real estate downturn, or are they engineered products living off return of capital? There's a difference. Step 2. Build what I call a core and explore portfolio. Your core, maybe 70 to 80%, should be in dividend growth ETFs like SCHD, DGRO, or VIG, or individual dividend growth stocks if you like picking. The other 20 to 30% can be your higher yield satellite holdings if you really want that monthly income feel. But please don't make high yield ETFs your entire portfolio. Step 3. Track your yield on cost, not your current yield. This is the number that actually matters. Yield on cost is the dividend you're receiving divided by what you originally paid. After 10 years of dividend growth, a stock you bought yielding 3% might be yielding 9% on your original investment. That's the magic that compounds quietly, while everyone else is chasing the flashy number. Step 4. Automate everything. Set up DRIP, dividend reinvestment plans. Set up automatic contributions. Take your hands off the wheel. The biggest enemy of compounding is you. Your urges, your fear, your greed. Remove yourself from the equation. Let me tell you about a guy I'll call Tom. Tom started investing in 1995 with $20,000. He put it into a simple dividend growth portfolio, basically just the dividend aristocrats. He never added another penny. He just reinvested dividends. Tom called me a couple of years ago to ask about something unrelated and casually mentioned that his portfolio is now worth over $400,000 and pays him about $14,000 a year in dividends. From $20,000. 30 years, no additional contributions. Now, imagine Tom had been putting in $500 a month that whole time. He'd have well over $2 million. That's not because Tom was a genius. Tom is not a genius. Tom is a plumber. He never read an investing book in his life. He just bought boring companies that raised their dividends every year and didn't touch them. That's the entire game. So to answer the question in the title, which wins for 2026 passive income? For 95% of you watching this video, dividend growth investing wins. It wins on total return. It wins on long-term income. It wins on tax efficiency because qualified dividends are taxed at 15 or 20% versus the ordinary income rates that hit a lot of high-yield ETF distributions. It wins on psychology because it forces you to think long-term. The only people for whom high-yield ETFs make sense are folks already in or very near retirement who need income today and have a shorter time horizon. That's it. Look, I know this isn't the answer most people want. Most people want to be told they can take $50,000, dump it in some ETF, and live on $5,000 a year of passive income starting next month. That's the dream the industry sells. But the real dream, the one that actually comes true, is way more boring and way more powerful. It's the dream of waking up 20 years from now and realizing your dividend income just crossed your monthly expenses. and it grew there quietly while you were living your life. If this video opened your eyes even a little bit, do me a favor. Hit that like button. It actually helps the channel out more than you realize. And subscribe if you haven't already, because I drop videos like this every single week. Drop a comment below. Are you team dividend growth or team high yield? I read every single one, and I'll be in there responding. Now, go check your portfolio. Make the changes you need to make. And I'll see you in the next one.